Hello, everyone. Ed Yardeni here with Bailey. We've got, as I've told you before, we've got 3 dogs here that belong to us and another one that belongs to my mother-in-law, and we're all here today anyways. Bailey is the younger of the 3 of them, and they're all King Charles Cavaliers, and she's heavy, so we feel her pretty good. All righty, so much to talk about. It's August 29th. Summer is just about over. September is coming, and September has a reputation of being a tough month for the market. But it looks like we started thinking about September already in August, as we've had a tough few days here, particularly on Friday when Fed Chair Powell decided to turn more hawkish. Most of the headlines were that he didn't pivot. So I guess there was a lot of people out there thinking that his press conference at the end of July was an indication that he might be somewhat more dovish. But as you know, just about every Fed official afterwards came out and tried to walk back that impression. So I don't know why the markets were that surprised that Powell turned even more hawkish. So he pivoted in that direction. I think he realized that talking off the cuff can get you into trouble, which is what happened with the press conference. And as a result, he felt like he had to walk it back and maybe talk more hawkishly than would have been the case otherwise. So let's not forget, Powell is the fellow who decided that Fed chair should have a press conference after every FOMC meeting. There's 8 FOMC meetings every year, and he does a press conference after each one of them. Before that, it was quarterly. And way back when Volcker was around, there was no official press conference. Volcker just kind of did what he needed to do and left it at that. So this goal of transparency and clear communications that the Fed has had can backfire when they talk too much. And clearly over the years, we've had what I've called the Fed's open mouth committee. Fed officials after FOMC meetings start squawking away, talking some dovishly, some hawkishly. But all in all, I think the Fed may want to once again reconsider its communication procedures. Maybe it'd be better if they just issued a longer statement of what transpired at the meeting and what they're thinking about. And dare I say, should they maybe impose a gag order on FOMC officials? I don't think that's going to work. They love to talk. They love to get on the media. So it is what it is. We have to deal with it. And so the markets went from this nice rally we had from June 16th low to the August 16th high. So in 2 months, the market had a nice big move, about 15%. And now we've given back some of that on Friday and maybe today as the market reassesses the risks of a recession. I think what the big difference was, the big difference between what Powell said at the presser and what he's didn't say now, or did say now, is at the presser he said that he thought there is a path that the Fed could go down that would allow inflation to come down and that wouldn't necessarily cause a recession. Their goal was to reduce the amount of help wanted, not to reduce employment. And he thought that there was enough of that kind of cushion in the labor markets that could happen. But now all of a sudden on Friday, he's talking about you can't bring inflation down without causing some pain, and didn't talk anything about that the Fed has a path for bringing inflation down without causing some pain. So the pain was pretty immediate in the stock market. Let's go to the video here, to the charts, and have a look at what we're covering in Monday's morning briefing. So as I said, the Fed, and as we all know, the Fed clearly had an impact on the market. And you can see that, I guess for those of you who are technicians, you can put your ruler here, draw a straight line that gets right to this top part here on August 16th. You can see this was the 200-day moving average. So we didn't take that out. We're above the 50-day moving average. Now the question is, will we take out the 50-day? And if we take out the 50-day, people are going to start talking about retesting 3666 on June 16th. At this point, I don't think that's going to happen. I think sentiment was extremely pessimistic here. I think a lot of people that wanted to sell, that got nervous about a recession, already did so. So I'm not quite convinced that we necessarily are going to go back to this low. Let's see what it does with the 50-day. I'm not a technician, so I'm not going to spend any more time on discussing that chart. What I do think from a fundamental perspective is that we're going to experience something that I would call a rolling recession. And in a rolling recession, the economy may not grow very much, maybe a growth recession as well, in which case earnings should kind of go sideways. And the volatility in the market, as is always the case, really will be determined by the valuation multiple. And the valuation multiple of late has gone from something like a little over 15 to something like 18 during this rally situation. It's about 15.3 here. And I think we got to a little over 18 over here on the forward PE basis. But now we're probably back down to about 17, maybe getting into the 16 and a half region. The fixed income market certainly responded right away to Powell's hawkish talk on Friday. And so we saw the 2-year Treasury yield going up to 3.34%. As you know, right now, the top of the range for the Fed funds rate is, well, the range is 2.25% to 2.5%. And this suggests that within the next few months, within the next 12 months or sooner, the 2-year note is anticipating that we're going to be at 3.34%, which really means that the range will probably be 100 basis points higher at 3.25% to 3.5%. And then the question is, do we go even closer to 4%? I don't think so. I think that along the way here, we're going to get some. I think along the way here, I think we're going to get some evidence that Fed policy has already been quite tight. The mortgage yield soared, not just because the 10-year soared, but also because the spread between the mortgage yield and the 10-year widened, and it did so to a large extent because the Fed started talking about quantitative tightening and how they were going to reduce their mortgage-backed securities holding, and some Fed officials actually indicating they wanted to get out of the mortgage business entirely, just basically let the whole thing mature, or even sell it and buy treasuries with it instead. So that's where that all went. I mean, it would be sort of ironic, right? But not that surprising if Powell just turned sort of maximum hawkish in his pronouncements, just as we're going to get some evidence that the economy is weak and that inflation's coming down. So we have that already. We have that in the Purchasing Managers Index for manufacturing. You can see that the S&P Global, it's the old market, the S&P Global bought market. So they bought this survey, and so you can see that the red line for manufacturing is still above 50, but it's coming down, and it does suggest that when the MPMI comes out for in September 1st, that it's going to be closer to 50. No big catastrophe here, but definitely a slowing of the economy, particularly in the good side. But the real surprise is that the S&P Global flash number is actually quite weak in August at 44, and that let me just turn that off. I thought I turned it off. Yes, I did. Technology is a wonderful thing. It's the fat finger that missed the right button there. But at any rate, what we're seeing here in the NMPMI, which is, it's often called the services PMI, but it includes construction. So maybe some of this weakness is actually in the area of construction, and you can see that that's come down quite a bit. And so we're going to get both of the national numbers pretty shortly. Okay, so then we've also got the 4 Fed districts. We've got the general business, the 4 Fed districts that are, I guess Dallas really just came out, so I'll probably write up the 5 of them. But the 4 Fed districts, you can see the general business conditions index in blue is below 50, or below 0, actually, is the way this is run, but we line up with 50. And that implies that the NMPMI will actually be down to 50 or less. 48 is really what the ISM says is the level for worrying about a recession. So something like north of 48 would just be a sign of very slow growth or no growth, but not a recession, at least in manufacturing. This tends to be heavily weighted towards manufacturing. Then the national NPMI for new orders, that doesn't look so happy. Again, we've had this kind of pileup of inventories, particularly at retailers, so that kind of makes sense. The labor market still looks okay from the point of view of the 4 districts. We're kind of over here. The NPMI, not so much, but again, there's a manufacturing, non-manufacturing issue in these surveys. They're not exactly clean cut in terms of who they cover. But then, of course, on September, at the end of this week, we're going to get the payroll employment numbers. And it looks like that should continue to show strength. However, it's interesting to observe that household employment has kind of gone sideways, as has the labor force. So I'm not quite sure what the discrepancy here is. Household employment is the number of people with jobs, whether they have 1, 2, or 3 jobs or whatever. And payroll is the number of jobs. Can't quite put my arms around why that should be giving us a different kind of pattern here. But this suggests that the number of people with jobs, no matter how many they have, has actually gone flat. And they tend to obviously correlate. One is the household measure, the other is the payroll measure. Then we talked about the CPI. I think that comes out, the August CPI reading comes out September 13th. And again, that'll be pretty close to the September 21 meeting of the FOMC. And we've been anticipating for a while that the durable goods inflation rate on a CPI and PCED basis was one of the main sources of this inflationary shock. And that's likely to come down pretty rapidly. And I think it could come right back down to 0 here. Durable goods tend to fall in prices. They don't tend to consistently go up in prices. So we're talking about things like furniture, appliances. Those prices are coming down as the housing recession has its impact. But then the question is used cars. And the answer is those prices have stopped going up and are starting to come down. And then new car prices, they have not yet come down, but I mean, they're not going to keep going up, up, and up. So at some point, the rate of change slows down. Oops, sorry about that. Oh, then another important one is gasoline. You can see this figure 8 shows the CPI gasoline index. And then we managed to set up this chart so that you can see the national retail price of gasoline on a 4-week basis. And we're using the same scale because the gasoline is in cents instead of dollars. So it's kind of pretty nifty chart to monitor what's happening to gasoline prices in the CPI and the PCED. And as you can see, right through the August 22nd week, gasoline prices have been taking a dive. So we know that the July CPI got improved just to an important extent because gasoline prices had come down after going straight up, and now they're starting to come down. So that's an encouraging development. I also wrote about the discrepancy between gross domestic product and gross domestic income. John Hilsenrath, just by coincidence, I guess, got the same inspiration. So we both wrote the same story at the same time. He did that in the Wall Street Journal. I did it in our morning briefing. And the main point is that the gross domestic product and the gross domestic income tend to be almost identical. In theory, they should be identical. One is measuring the income side of the economic equation. Incomes are generating by producing things and services, and so that they should equal. But it is a statistical compilation of data, and there's going to be a statistical error. But this is the biggest error or statistical discrepancy of all times, going back to at least 1948, where the data starts. And you can see that's like $1 trillion discrepancy. And the question is, which one is right? And the BEA has acknowledged this problem and said just average the two of them together. But the BEA also at some point is going to do its revisions. And I won't be surprised at all if the negative GDP numbers in the first half of the year get revised to show that we had either zero growth or slightly positive growth. Let's move on here. We did a section on corporate profits. The Q2 numbers are now out. We just went through the whole earnings season, reporting season, and now we're able to put all the data together and get the actuals. And pretty impressive, I think. I mean, revenues is the blue line here, all-time record high. Some of that, of course, is price inflation. It is what it is. Also quite impressive is operating earnings as compiled by IBEST data by Refinitiv, which is the data we track. And you can see that that had a big move to the upside. So here with all the talk about recession and doom and gloom, companies still managed to generate record revenues with record earnings. The growth rate has been coming down. So revenues growth is cyclical on a year-over-year basis. We're down to 12.1%. These numbers, again, are all being elevated by inflation. You can see that previous cycles in the revenues were peaked at lower inflation, lower rates than this one. But again, inflation being the booster of revenues, and some of that has in fact gone into earnings growth, and earnings growth 9.5%. So I guess now what we're doing is worrying about this kind of scenario where we turn negative. If in fact we wind up drawing a blue shade that there's a recession here. If it turns out to be a rolling recession, as I think, and again, we'll have more to say about it in the morning briefing this afternoon for tomorrow, then this could just continue to go down closer to zero without actually turning negative. We had something like that here, where we had this sort of mid-cycle slowdown. We had this mid-cycle slowdown over here without an actual outright recession. And the market kind of went sideways, I believe, in both of those situations on its way to going up to new highs. So that's kind of what I'm thinking. Meanwhile, the margin, for all the talk about margins getting squeezed, you're still not seeing it in the S&P 500 composite. The margin remains historically high, near its record high at 13.4%. Though clearly, once you drill down the sectors, you can see that consumer discretionary, for example, are in fact having some issues. By the way, with the second quarter revisions to GDP, we also got the profits data. And as you can see, the national profits data rose to a record high over here in the second quarter. This is a comparable measure using the S&P reported net income. It's went flat at a record high, and S&P accounts for roughly 50% of the corporate profits that are included in GDP. Those profits in GDP also include subchapter S corporations. There's a lot in there that's not in the S&P 500. So again, but the S&P 500 is still obviously pretty impressive, accounting for half of the revenues and earnings of corporate America. Profit margin, again, going from the national income accounting perspective, the different measures of this thing, but this is the S&P 500. This is the national income and product account margin, all-time record high. I have to believe these things are peaking here. I can't imagine they're going to get any better, but I think it's important to keep in mind that when you look at the overall national numbers for profits, what you see is that after-tax corporate profits was $2.6 trillion. So it's at an all-time record high. Dividends, all-time record high of $1.5 trillion. And a lot of that gets plowed back into the stock market. So it kind of feeds bull markets, or at least that offsets some of the bearish tendencies in bear markets. And then there's the undistributed profits, which were $1.1 trillion. I know a lot of, let's call them, progressive politicians tend to look at corporate profit and say, my God, buybacks and dividends are accounting for 100% of corporate profits. Well, that's really not the way you're supposed to look at. That's not the way that accounting works for corporations. The important thing to realize is that undistributed profits combined with the greatest tax shelter of all times, which is tax reported depreciation, is equal to corporate cash flow. And corporate cash flow is at an all-time record high of $3.4 trillion. That's the kind of cash that they have. And they've been using that to expand capacity, to pay workers, to have stock compensation plans, and to buy back their shares and to pay out dividends. Though they do pay out dividends, obviously, from total tax after-tax profits, and then what's left is undistributed profits, and then you add that tax shelter of depreciation, and that's how you get this big number. So corporations are in great shape in America, and a lot of this, the data, I think, all in all, is still pretty positive on things. Let me take a drink here. And I got two questions. If anybody else wants to join, we got a little bit of time. So John asks, in the economic environment you see, which sectors and industries should excel? Well, I guess it also depends on not just the environment I see, but also the time frame I'm looking at. I think over the rest of the year, the market's going to remain challenging. Maybe we continue to have these kind of violent swings from growth to value. Right now, from June 16th through August 16th, it's basically back to growth with tech and communication services doing quite well. Financials did okay, though financials tend to be viewed as value. And then over the past week or so, particularly on Friday, we started to see risk off again and a move back towards value away from growth. I think these things are going to continue to be kind of volatile, mostly because I think there'll be a debate about what earnings are doing. And I take the position that earnings are going to go sideways in a growth recession kind of environment and a rolling recession kind of environment. And valuation is highly subjective and highly psychologically determined by market sentiment. Again, I think market sentiment was extraordinarily pessimistic on June 16th. I don't think we're going to get that pessimistic again. So I don't think we're going to retest the June 16th low. But, you know, could we drop below 4,000? We could. I have to look at my screen here to make sure things move so fast. We may already be under there for all I know. But all in all, I think looking kind of beyond the next 3 to 6 months, looking into next year, I think technology still makes sense. I think energy makes sense and financials make sense. So in other words, it's sort of a balanced portfolio of growth and value. I'm not picking sides here on it's got to be growth, it's got to be value. Do you think that the 10-year Treasury yield will go over 3.5%? Short answer is no, I don't think so. We have some indicators that we watch. A big fan of the copper gold price ratio, and that suggests that that should be closer to 2% than 3%. But right now it's 3%, a little bit above that. The Citigroup Economic Surprise Index tends to be a useful indicator for the bond market, and that's looking also like bond yields shouldn't be going up much from here. And I think we have to, respect the history of the yield curve. The yield curve tends to invert when fixed income markets start to anticipate that if the Fed continues to tighten, something will break, and therefore it's okay for short-term rates to go up and for long-term rates not to go up anymore, because short-term rates are going to, in the short term, create a problem, a credit crunch problem, which then causes a recession. So I think that's part of the story. I think another part is TNEC. There is no alternative country. The dollar's been very strong. Whoever's buying dollars, I think, is mostly putting them into fixed income securities rather than into the stock market. Though I do think that foreigners will be coming to our stock market as well. Okay, will QT eventually impact liquidity and, more importantly, impact risk assets? Well, it's really it started already back in June, July, August at a slow pace, and now they're going to speed it up to 95 billion per month in letting their portfolio mature, and that's after not too many months ago, they were actually buying 120 billion. So it looks like it's a pretty daunting kind of reversal from the Fed buying 120 billion per month to letting $95 billion roll off. And you would think that things would be a lot worse in the fixed income markets. And they are in the mortgage market. As I said, the mortgage yield has soared, not just because the 10-year soared, but also because the spread has widened quite dramatically. But I think that the yield curve is saying that the Fed's already restrictive enough that it doesn't have to do much more, and that if it does do more, that increases the risks that something will break, which in turn increases the risk of a recession. Again, I think we're seeing a rolling recession. Housing is in a recession right now. Autos is in a recession, not because there's no demand, but because there's no supply. There's an issue with inventories. Retail inventories have piled up, so they're going to have to discount those to sell them. They will sell them, but they're not going to order as much until they kind of clear out the pile that they've got now. But the good news is that they'll put downward pressure on price inflation. So I just kind of see these things kind of rolling along, and with an economy that on balance just doesn't all at once go down. Doug, what is your count of how many pivots Powell has completed in his term as chair, and what do you think could cause him to pivot again? Well, I wrote a book called Fed Watching for Fun and Profit, and it ended in 2019. And the chapter on Powell's called Jerome Powell, Pragmatic Pivoter. So even back then, I had enough material to name the chapter Pragmatic Pivoter. But certainly we can all recall 2018, he said something to the effect of, we're a long way off from neutral. You should stay away from the word neutral. But he said, we're a long way off from neutral. And the market took a dive, almost 20% in the early winter, in the fall and early winter of 2018. And then he pivoted, he reversed himself, and suddenly they were actually lowering interest rates in 2019. Then I guess you could argue that the Fed pivoted to an ultra bullish, ultra stimulative stance with the pandemic, and they made that even more stimulative when they in August of 2020 issued a revised statement of their long-term goals, in which they prioritized maximum employment. So the Fed turned extremely woke, focusing on that, and said, we're not really going to pay much attention to inflation. Then all of a sudden, inflation makes a big comeback. It's no longer transitory, it's persistent. And Doug, I hope you're counting, because I forgot to count. But then there's another pivot that occurs in late 2021, early 22, Fed's hawkish. And then I don't know what you call the current situation, where you seem to talk somewhat more dovishly, sorry about that, and at the press conference, and then all of a sudden now he turned super hawkish. I mean, again, the papers reported like he didn't pivot because maybe people were expecting something dovish, but he certainly pivoted towards a more hawkish stance, which probably means that the next pivot will be to something more dovish again. Do you expect accelerated share buybacks with the recent law passing, and will that improve sentiment and your year-end target? My year-end target is, I don't think we're going to go back to record high territories anytime soon. I think optimistically we might get back to 4,300, but that's consistent with what I think is a better than expected outlook for the economy than generally. I think, especially after Friday's talk, recession concerns are going to mount again. But I would say that the buybacks, I don't think the law is going to change much. They're apparently going to slap a 1% tax on buybacks that are not related to employee stock compensation plans. I'm glad to see that they got that in there. I've been for a while arguing that a good significant chunk of buybacks are related to stock employee plans, and you don't want to mess around with that. So apparently they don't. But we have been seeing record buybacks, record dividends, add them together, and you got over $1 trillion kind of getting plowed back into the stock market. And so I kind of call this the CFO put. The CFO put has, to a certain extent, not completely, obviously, replaced the Fed put. Let's see, I'll take one more here. Do you expect accelerated share buybacks? Oh, no, I guess that's the same question. Yeah, same question. So Bing, do you believe the U.S. is about to undergo a significant capex boom that might offset some of the weakness from the global economy? Great question. It's one we're working on. I think Wednesday or so we get productivity and labor costs, and it's going to be a bad number. The first and second quarter productivity numbers were bad, and on a year-over-year basis, their productivity is down 2.5%, which is the most since the data was first compiled in 1948. So I was kind of hoping that we'd see signs of the roaring 2020s, where because of the labor shortages, companies would say we got to spend more on technology and capital equipment to increase the productivity of the workers we have. Well, I still think that's a likely scenario for the decade ahead, but for the here and now, it looks as though between the pandemic and people working from home, supply disruptions, it looks like productivity is not doing very well at all if the official numbers are correct. Look, it's conceivable that the GDP numbers will be revised higher, and if they're revised higher, the productivity numbers will be revised higher. But they're so awful that I don't know that it's going to kind of completely turn the story around. And so you have to conclude that everything since the pandemic has been sort of messed up relative to the way we're used to thinking about things. Certainly things have, the whole business cycle has been sort of like on speed and steroids, just running much faster than one would have thought in the past. But the short answer is, I think right now, with the economy growth rate not doing much, with some of the indicators suggesting that companies are turning somewhat cautious on capital spending, I don't think we're going to get a capital spending boom anytime soon. I mean, it's usually corporate profits do drive capital spending, and they are an all-time record high. But you look at the things like CEO confidence, it's been coming down the past couple of quarters, and that tends to affect capital spending. I'm also looking at data on U.S. capacity in manufacturing, and what I see there is it's still flat. I mean, it's flat since China joined the World Trade Organization. So it's the notion of onshoring has yet to be reflected in the macroeconomic data. I mean, clearly, anecdotally, we know stuff is coming back and being made in the United States or closer to home anyways, but it's not showing up in the data yet. So right now, the roaring 2020s is something for us optimists to continue to hope for and look for signs that it's happening. But right now, we're all kind of struggling with the notion of what is the economy doing on the weak side? Is it going to be a traditional recession, a growth recession, or what? So with that, let me thank you all for joining this week. I'll probably do one next week, Tuesday, because Monday is Memorial Day. So once again, thanks for joining me.